Mr. AG Asian Guy here. The global silver market has entered a transformative era that most people still don't fully understand. What we're living through right now is being called the Great Revaluation of 2026. Silver touched an all-time high of $120 per ounce in late January. Then it crashed. Now it's stabilizing around $77. And most people watching these moves think this is just normal volatility. It's not. This is a fundamental shift in how the world perceives silver. This is no longer just a precious metal for jewelry and investment. This is now a strategic industrial asset at the heart of the global energy transition. And China just weaponized it. Let me tell you what happened on January 1st, 2026, because this single event explains everything that's happened since and everything that's about to happen. The Chinese government implemented stringent export restrictions on refined silver. They replaced their decades-old quota system with a restrictive new licensing regime. Under these new rules, only 44 state-authorized companies are permitted to export refined silver. 44 companies in a country that controls 60 to 70% of the world's silver refining capacity. Let me say that again. China controls between 60 and 70% of global silver refining. And now only 44 companies approved by Beijing can export that refined silver to the rest of the world. This is not a minor policy adjustment. This is weaponization. This is China leveraging its dominance in the refining sector to effectively tighten the spigot on the world's silver supply. This sent shockwaves through Western industrial hubs. This forced a massive deleveraging event in the paper silver markets. And this triggered the panic buying that propelled prices from $35 in December to the $120 peak in late January. The subsequent correction to $77 has provided some relief, but make no mistake, the floor for silver has been permanently elevated. The days of $20 silver are gone. That era is finished. What we're witnessing is a structural repricing of a metal that the world cannot function without. Before we go any further, let me tell you what this channel is about. I don't sell courses. I don't sell signals. I don't sell anything. What I do is break down market data, show you both sides of every argument, and give you the framework to make your own informed decisions. I'm not here to pump silver or scare you away from it. I'm here to help you understand what's actually happening so you can position yourself intelligently. If you want someone to tell you silver is going to $500 tomorrow, find another channel. If you want someone to tell you it's crashing to $30, find another channel. I'm here for people who want to understand the geopolitical and supply chain dynamics that are reshaping this market in real time. Now, drop a comment right now. Where are you watching from today? I want to know what country, what city. I see viewers from all over the world. United States, Canada, United Kingdom, Germany, Australia, India, Singapore, Philippines, Japan, China, South Africa, Brazil, Mexico. Let me know where you're tuning in from. And tell me, did you see this coming? Did you understand what China's export restrictions would do to this market? Or are you just now realizing the magnitude of what's happening? I want to hear from you. Let me walk you through the roots of this crisis, because the January price explosion didn't come from nowhere. This has been building since 2021. Between 2021 and 2025, the global silver market saw a cumulative deficit of approximately 800 million ounces. Let me put that number in perspective for you. Global mine production is roughly 800 million ounces per year. So the cumulative deficit over those 4 years equals nearly a full year of global mine production. The world has been consuming more silver than it produces for 6 consecutive years. 6 years of structural deficit, 6 years of drawing down inventories, 6 years of the gap between supply and demand growing wider. Why is demand surging? 3 words. Solar. Electric vehicles, artificial intelligence. Silver has become indispensable for photovoltaic cells and solar panels. Silver is essential for the electronics in electric vehicles. Silver is critical for the infrastructure powering artificial intelligence. As the world rushes to decarbonize, as the energy transition accelerates, as AI deployment expands, silver demand has exploded. Industrial demand has surged even as mine output remains stagnant. Mining companies have not been investing in new silver production. Most silver comes as a byproduct of copper and zinc mining, not from dedicated silver mines. There's been no incentive to develop primary silver mines when prices were stuck at $20 or $25 for years. By the end of 2025, the US government took an unprecedented step. They officially designated silver as a critical mineral. Think about what that means. The United States government looked at their supply chains, looked at their dependence on foreign sources, looked at the strategic importance of silver for solar panels, electronics, defense applications, and declared it a critical mineral. This was a signal to the world that silver was no longer a discretionary luxury. This was a signal that silver is now a matter of national security. And how did China respond? By tightening their grip. On January 1st, 2026, Beijing replaced the old quota system with the new licensing regime. Only 44 state-authorized companies can export refined silver. This is the same playbook they used with gallium and germanium, weaponizing control of critical mineral processing to gain leverage in broader trade negotiations. China saw the writing on the wall. They saw that the West was becoming aware of their dependence on Chinese refining, and they moved first to lock in their advantage before the West could respond. The immediate effect was panic. Western manufacturers who depend on refined silver suddenly faced uncertainty about whether they could even source the material. Prices exploded from $35 in December to $120 by late January, a 243% move in roughly 6 weeks. This was not normal market function. This was supply shock. This was geopolitical weaponization, creating price dislocation. And the correction from 120 to 77 was not the market saying the crisis is over. It was speculative excess being shaken out while the underlying scarcity remains completely unresolved. Let me talk about who is winning and who is losing in this revalued landscape, because the massive price swing has created a stark divide between the haves and have-nots of the silver world. The winners are obvious. Primary silver miners have seen their valuations skyrocket even after the February correction. First Majestic Silver Corp, trading under the ticker AG on the NYSE, is a pure-play silver producer with significant operations in Mexico. They reported record cash flows in early 2026. They benefited from their decision to hold back physical inventory during the peak of the squeeze. They didn't sell into the panic. They held their mettle. And now they're reaping the rewards of that patience. Pan American Silver Corp, trading under PAS on NASDAQ, has also emerged as a major winner. Their diversified portfolio and recent acquisition of Mag Silver positioned them perfectly to capitalize on the high margin environment. When silver goes from 35 to 77 or higher, and your cost of production hasn't changed much, your margins explode. These companies are printing money at current price levels. Streaming and royalty companies like Wheaton Precious Metals Corp, trading under WPM on the NYSE, have thrived as well. Their business model involves fixed cost contracts that allow them to capture the full upside of the price surge without the inflationary pressure of rising mining costs. When silver doubles, their revenues roughly double, but their costs stay the same. This is why streaming companies often outperform miners during price surges. But there are losers too, and they're significant. Industrial consumers are reeling. Solar panel manufacturers who need silver for photovoltaic cells are facing skyrocketing input costs. Electric vehicle makers who need silver for electronics and batteries are seeing their margins compressed. These companies are scrambling with what they call thrifting efforts, trying to reduce the amount of silver used in their products. But silver's unique conductivity properties make it extraordinarily difficult to substitute. There's no good alternative for many applications. So many tech firms have been forced to accept lower margins or pass costs onto consumers. For retail and institutional investors, the iShares Silver Trust, trading under SLV on NYSE Arca, has been the primary vehicle for participation. During the run to $120, SLV saw unprecedented inflows. This led to concerns about the physical availability of bullion in Western vaults. The widening gap between paper prices and physical premiums in London and New York suggests that the market remains fragmented and fragile. The paper market says one price. The physical market says another. This disconnect has been one of the defining features of the Great Revaluation. Quick pause here. Let me ask you something. Are you invested in any of these companies? Do you hold SLV or physical silver? Are you an industrial user who's been affected by these price increases? Drop your situation in the comments. I want to understand how this revaluation is affecting real people in real ways. Now let me talk about the geopolitical dimension, because this is what most financial analysts completely miss. The 2026 crisis has highlighted a glaring vulnerability in Western supply chains. It's not mining, it's refining. Countries like Mexico and Peru remain top miners of raw silver ore. They pull the metal out of the ground. But the vast majority of that material is shipped to China for processing. China takes the raw ore and turns it into refined silver that can be used in manufacturing. By controlling the refining stage, Beijing has gained the ability to dictate terms to the global market, regardless of where the silver is pulled from the ground. This gatekeeper status is now being used as a geopolitical tool in broader trade negotiations. When you control the processing of a critical mineral, you have leverage over everyone who needs that mineral. The US can designate silver as critical all they want. If they can't refine it domestically, they're still dependent on China. And China knows this. This event mirrors the 1970s oil shocks. It mirrors the recent volatility in the lithium market. But there's a critical difference with silver. Silver is both an industrial necessity and a financial safe haven. Oil is energy. Lithium is batteries. But silver occupies a unique space as both a critical industrial input and a monetary metal that has served as money for thousands of years. This dual nature means silver responds to both industrial demand dynamics and monetary policy sentiment simultaneously. It's more complex than other commodities. The Great Revaluation fits into a broader trend of resource nationalism. Countries are increasingly prioritizing domestic industrial needs over global trade. Globalization, at least in critical minerals, is reversing. Nations are asking themselves, what do we control? What can be cut off? What are we dependent on that could be weaponized against us? Silver is now front and center in those conversations. The US and EU are now fast-tracking permits for domestic silver processing plants. But experts warn that it could take years to decouple from Chinese infrastructure. You don't build refining capacity overnight. It requires permitting, construction, specialized equipment, trained workers, environmental compliance. We're talking about a multi-year timeline to reduce dependence on China, even if everything goes smoothly. And historically, such shifts in supply chain control lead to prolonged periods of higher prices and structural inflation in the affected sectors. Let me talk about what comes next, because this is what everyone wants to know. The short-term outlook remains clouded by the tug-of-war between physical scarcity and technical corrections. The drop from $120 to $77 was a necessary cooling-off period to shake out speculative excess. The leverage that drove prices parabolic needed to be cleared. Positions that were established at 90 or 100 or 110 on margin got liquidated. That's what happens after parabolic moves. It's healthy, it's necessary, but the underlying deficit remains completely unaddressed. Analysts expect silver to trade in a volatile range between $70 and $90 for the remainder of the year. This is the new normal. Not $20, not $30, $70 to $90. The floor has been permanently elevated by the structural realities of supply and demand. The primary challenge for the market will be the continued depletion of exchange-monitored vaults, which are at their lowest levels in over a decade. COMEX inventories are declining. London vaults are under pressure. The SLV Trust has absorbed massive inflows while physical availability remains constrained. Every ounce that goes into an ETF vault is an ounce that's not available for industrial use. Every ounce that goes into Chinese strategic reserves is an ounce that's not coming back to market. The mathematical reality is that there's not enough silver to go around at current consumption rates. Strategically, the industry is pivoting toward closed-loop recycling. Companies are investing heavily in technologies to recover silver from decommissioned solar panels and electronic waste. This makes sense. If you can't mine enough new silver and you can't refine it fast enough, you need to recover what's already been used. But these recycling sources currently account for less than 20% of total supply. It's helpful, it's growing, but it's not going to solve the deficit on its own. In the long term, the high price of silver may finally incentivize the development of primary silver mines. For years, mining companies have neglected dedicated silver projects in favor of byproduct mining from copper and zinc. When silver was $20, pure silver mines weren't economical enough to attract capital. At $77, the economics are completely different. Primary silver mines that were marginal before are now highly profitable on paper. But there's a catch. The lead time for new mines is 7 to 10 years. You don't just decide to open a mine and start producing. You need exploration to find the deposit, feasibility studies to prove the economics, permitting from multiple government agencies, financing for construction itself, and then ramp up to full production. 7 to 10 years minimum, which means the supply crunch is unlikely to resolve before the end of the decade, even if mining companies start aggressively developing new projects today. Let me give you the bearish case now, because I always present both sides. Here's what could go wrong from here. First, the correction could continue. We've dropped from 120 to 77. That's a 36% decline. But in the context of a move from 35 to 120, we're still massively elevated. Further correction toward the 60 to 70 range is possible if speculative positions continue to unwind. Second, China could ease restrictions. Beijing implemented these export controls for strategic leverage, but if they achieve their objectives in trade negotiations, or if the restrictions cause too much domestic economic disruption, they could relax the licensing requirements. Any signal of loosening would immediately relieve supply pressure and push prices lower. Third, industrial demand could weaken. Solar installation could slow due to high silver input costs. Electric vehicle sales could disappoint. AI infrastructure build-out could face delays. If industrial demand doesn't grow as fast as expected, the deficit could narrow. Fourth, substitution and thrifting could accelerate. Every industrial consumer facing a $77 silver is scrambling to use less of it. Solar panel manufacturers are redesigning their products to require fewer grams of silver per watt. Electronic manufacturers are engineering alternatives. If these efforts succeed faster than expected, demand could decline. Fifth, recycling could scale faster than anticipated. If recovery rates from electronic waste and solar panel recycling improve dramatically, secondary supply could fill more of the gap. Sixth, the global economy could weaken. A recession would reduce industrial demand for silver across all sectors. Safe haven demand might offset some of that decline. but overall consumption would fall. Seventh, paper market dynamics could overwhelm physical realities. We saw during the crash from 120 to 77 how quickly leveraged positions can unwind and push prices violently lower, regardless of physical fundamentals. Another wave of deleveraging could create another sharp decline. These are real risks. I'm not dismissing any of them. The bullish case is not guaranteed. Markets don't move in straight lines. Now here's the bullish case. First, the structural deficit is unresolved and growing. 800 million ounces of cumulative deficit over 4 years. 6 consecutive years of supply shortfall. This doesn't get fixed by a price correction. This requires either massive new supply, which takes 7 to 10 years, or massive demand destruction, which isn't happening because industrial uses are essential. Second, China's export restrictions are structural, not temporary. This isn't a one-time supply shock. This is a new policy regime. Only 44 companies can export. That chokehold remains in place until Beijing decides otherwise, and there's no indication they're planning to loosen it. Third, the critical mineral designation changes everything. The U.S. government has officially acknowledged silver's strategic importance. This will drive policy support, stockpiling initiatives, and investment in domestic production. Government involvement typically supports prices. Fourth, the energy transition is accelerating, not slowing. Solar installation is growing exponentially. Electric vehicle adoption is increasing. AI infrastructure is expanding. All of these require silver. Industrial demand is structural and growing regardless of price. Fifth, vault inventories are at multi-decade lows. Exchange-monitored stockpiles are depleted. There's less cushion to absorb demand shocks. Any unexpected surge in demand could trigger another price spike because there's simply not enough accessible inventory. Sixth, mining companies are underinvested in silver. Years of low prices led to neglect of silver projects. Even with today's high prices, new supply is years away. The supply response is structurally delayed. Seventh, the refining bottleneck cannot be quickly resolved. Even if the West fast-tracks domestic processing capacity, it takes years to build. The dependence on China persists for the foreseeable future. Eighth, the monetary case for silver remains strong. Currency debasement concerns, inflation fears, central bank credibility questions, these factors support investment demand for precious metals. Silver benefits from this as a monetary asset alongside gold. Ninth, the $70 to $90 range represents consolidation, not reversal. The market is digesting the move from 35 to 120. It's building a new base at structurally higher levels. This consolidation sets up the next leg of the move. Let me ask you another question. Given everything we've discussed, where do you think silver goes by year end? Do you think we stay in the 70 to 90 range? Do you think we break higher toward 100 or beyond? Do you think we correct further toward 60? I want to know what the community is thinking. Drop your prediction in the comments. Here's what I'm watching to confirm or deny these scenarios. First, Chinese export data and the whitelist of authorized refiners. Any further tightening of licenses could easily trigger another spike toward triple digits. Any loosening would relieve pressure. Second, vault inventory levels. COMEX, London, SLV holdings. If inventories continue declining, physical scarcity intensifies. If inventories stabilize or grow, supply pressure eases. Third, industrial demand indicators, solar installation data, electric vehicle sales, AI infrastructure spending. These tell us whether the demand side of the equation remains strong. Fourth, new mine development announcements. Any significant projects being fast-tracked would signal future supply relief, though the impact would be years away. Fifth, Western refining capacity development, progress on domestic processing plants in the US and EU. The faster this develops, the less dependent on China the West becomes. Sixth, the $70 support level. This appears to be the floor of the new range. A breakdown below 70 with conviction would signal further downside risk. Holding above 70 keeps the bullish structure intact. Seventh, the $90 resistance level. A breakout above 90 with volume would signal the consolidation is ending and the next leg higher is beginning. Let me bring this back to the big picture because I think it's important to understand the magnitude of what we are witnessing. The Great Revaluation of 2026 has fundamentally altered the silver market's DNA. We have transitioned from a $20 per ounce commodity to an $80 per ounce strategic asset. This transition has been painful for industrial consumers, but a windfall for producers and long-term holders. The key takeaway for the market is that silver's days as a forgotten metal are over. It is now a central pillar of the green energy economy. It is now a front line in the ongoing trade war between East and West. It is now a matter of national security for major economies. This changes everything about how silver is valued, traded, and stockpiled. Moving forward, keep a close eye on Chinese export data and the whitelist of authorized refiners. That's where the supply side of the equation is controlled. Watch the development of domestic refining capacity in North America, because that will determine how long Western dependence on China persists. And understand that the $77 price point may just be the beginning of a new, more expensive chapter for what's being called the indispensable metal. 3 key takeaways and we're out. Number 1. China's January 1st, 2026 export restrictions fundamentally changed the silver market. Only 44 state-authorized companies can now export refined silver from a country that controls 60 to 70% of global refining capacity. This triggered the explosion from $35 to $120 and established a new floor around $77. The old $20 to $25 price range is finished. The market has structurally repriced to reflect silver's new status as a weaponized strategic asset. Any further tightening of Chinese restrictions could easily push prices back toward triple digits. The chokehold is real and ongoing. Number 2, the 800 million ounce cumulative deficit from 2021 to 2025 represents a supply crisis that cannot be quickly resolved. Industrial demand from solar, EVs, and AI continues growing, while mine output remains stagnant. Primary silver mines take 7 to 10 years to develop. Recycling accounts for less than 20% of supply. The U.S. designation of silver as a critical mineral acknowledges this reality, but doesn't change the math. Exchange-monitored vaults are at their lowest levels in over a decade. The physical scarcity is real, and the resolution is years away. Number 3, winners in this revaluation include primary silver miners like First Majestic and Pan American, streaming companies like Wheaton Precious Metals, and long-term holders who accumulated at lower prices. Losers include industrial consumers like solar panel manufacturers and EV makers who face skyrocketing input costs. The $70 to $90 trading range is expected for the remainder of the year. The market is consolidating at structurally higher levels. This is the new normal. Position accordingly based on your own risk tolerance and time horizon. The unresolved tension is this: physical scarcity is extreme and worsening. China controls the refining choke point and shows no signs of loosening. Industrial demand continues growing as the energy transition accelerates, but speculative excess has been cleared and the technical picture is consolidating. We're in a pause between the first explosive move and whatever comes next. The long-term direction appears up. The short-term path is volatile. Understanding the geopolitical and supply chain dynamics gives you an edge in navigating what comes next. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your timeframes. Are you investing for the 7 to 10 year horizon until new supply comes online? Are you trading the $70 to $90 range? Are you hedging industrial exposure? Different strategies require different approaches, different position sizes, different risk management. If you don't know which game you're playing, the market will teach you, and those lessons are expensive. The Great Revaluation of 2026 is not an event that happened. It's an ongoing process that's reshaping the silver market in real time. China's weaponization of refining capacity, the West's scramble to develop domestic processing, the depletion of vault inventories, the 7 to 10 year lag until new supply arrives. These are the forces that will determine silver's trajectory for the rest of this decade. The market has been forever changed. The only question is whether you understand the new rules and can position accordingly. Silver is no longer a forgotten metal. It is now the indispensable metal at the heart of the global energy transition and at the front line of the East-West resource competition. The $77 price you see today is not the end of a move. It may be just the beginning of a new chapter. Use your brain. Don't follow anyone blindly, including me. Do your own research. Make your own decisions. Understand the geopolitical forces at play. Understand the supply chain vulnerabilities. Understand the timelines for a resolution. And position accordingly. Let me know in the comments what you think. Is the Great Revaluation complete or just beginning? Where does silver go from here? Are you positioned for what comes next? I want to hear from you.